say we were talking about June last year, that my macro thesis at the time was that we were going to see some sort of insolvency phase, the overhang from this whole situation. That didn't happen because of the unprecedented amount of monetary printing that went on and the ongoing fiscal stimuluses. So then we look back and we realize that the worst recession in all recorded history only lasted 2 months. And that was all about, again, this stimulus. So if you are Janet Yellen and Jay Powell, you sit in a room together and go, that was pretty good, eh? It kind of worked. It worked for the financial crisis, and now it worked for the entire world closing down. Maybe we don't have to have a business cycle. Maybe we don't have to have risk anymore. So the marginal propensity for them to fire that gun again is extremely high. Well, the market sells off. Well, let's just add some stimulus. We're still not sure that equality is quite right. We'll add some stimulus. Every answer becomes we can add stimulus. So the market currently has been looking for strong growth, and Jay Powell was out today talking about potentially tapering because the growth numbers have been strong. But my work suggests that the economy is actually weakening. So China has a weak credit cycle and its GDP growth is falling sharply. Japan has got itself in a huge mess now with the COVID Delta variant. That's the third largest economy in the world. And Europe still stop-start. The US still not fully recovered. And it's normal. Normally it takes maybe 2 years to fully recover from a recession, and this was a big one. So after we call the end of a recession, generally the central bank cuts twice again after it because growth isn't fully stabilized. So we're in this phase where growth, I think, is starting to weaken. We see it in things like, the most dramatic being the University of Michigan sentiment surveys for buying climates of houses and cars and big ticket items. People have just gone, this is the worst buying climate we've ever seen. It's the worst numbers we've ever seen in these surveys because of the price rises that came from the supply shocks beforehand. We see rollover in ISM and these other business cycle surveys. So we're going into a period where the Fed are talking about tapering. The market really thinks inflation is the big enemy, and probably we're about to see a slowdown. Now, knowing that every single recession since 1962, the Fed cut rate twice after it, and we saw this little spike in bond yields first, and then bond yields went back to the all-time low almost every time since 1990 for sure. So the probability is for me that the economy's weakening, the Fed cut again twice, there's probably more fiscal stimulus to come, and the markets haven't priced this in at all. Now, in the context of what does that do for asset prices, well, I've talked to a lot about the significance of this printing. It doesn't come up in CPI, the inflation that everybody talks about. It comes in the fall of the value of fiat currency, the denominator. And we see that because basically you can divide any asset by the Fed balance sheet and everything's about flat. And you can do the same with German property and the ECB balance sheet, or UK property and the Bank of England balance sheet, or Swedish property. It works pretty much consistently. We're lowering the value of fiat currency overall. So if the Fed are going to do that, we should see a rise in the value of equities, the value of real estate, most assets, and especially cryptocurrency.
So your take is we're going to continue to see asset price inflation, but what about CPI inflation? I mean, there's definitely been murmurs of that. Of course, we hear from some of the Fed and economists that it's just transient, it's not permanent. Others say no, this is going to be more pernicious. It may go down and up in cycles, but the trajectory over the next 5 to 10 years is going to be up from a CPI perspective. What's your take on CPI inflation?
My big picture take on CPI inflation is it's almost impossible to make it go up. We have the baby boom generation who are now 70 and they're all retiring, so their consumption pattern falls significantly. And we've just seen over the last year the largest wave of retirees in all recorded history. And those people, once they retire, spend less money because actually their pot of final savings is not that big. But the ones that are still in the labor force are competing with their kids, the millennials. So you've got the two largest cohorts in all recorded history competing for jobs. Then we've got globalization. So if it's not bad enough competing against your parents, you're competing against Chinese and Indians. And if that's not good enough, you're all competing against the robots and AI. So that backdrop is, and in a massive credit bubble. So that backdrop is wildly, wildly disinflationary. The relentless rise of technology is hugely disinflationary. So can you generate CPI inflation? I don't think you can. You can't generate it in food because technology just destroys it, because crop yields keep going up, price of food keeps falling. You can't do it in basic stuff like clothing and furniture, none of that stuff, because technology keeps changing. You 3D print tables and chairs now, it requires no humans. You can do it just-in-time technology, need no inventory. And this is relentless. The only three things that went up over periods of time. One was housing, which we're aware of.
Another asset, of course.
Yeah, but rents have gone up as well. So
right.
that's not been easy. Healthcare. Well, no shit, Sherlock. If you've got 76 million baby boomers at 70 years old, they're competing for healthcare. So the costs go up, and that will continue. The other one was education, but that's collapsed, the rate of inflation, because the entire millennial cohort has now left university. Pretty much. I think they're all out now. So I think it's Gen Z in university. So the cost, the marginal consumption of education has gone down. So I find it very hard to see this. Now, are you going to be able to keep the price of copper and industrial materials higher? Copper, maybe because of the electricity boom that's coming. But overall technology lowers the price of copper. You can extract more copper. We saw that with fracking and oil. That's technology. That's how technology stops price rises. That's probably the best example in the world is, you cannot keep the price of oil higher because technology keeps dropping it lower. So no, I don't believe in CPI.
That is a good example. So this is kind of a mental model buster, I guess, for me. So my model of things, or my best guess going into this, was like, hey, over the last 10 years, we sort of saw the asset price story, an asset price inflation story, right? Ever since 2008, kind of, Fed printing, money supply increasing, eventually it's going to asset prices. I mean, you're kind of saying, and then in my mind, I sort of thought, well, the next 10 years might play out and some of that asset price inflation might sort of seep into CPI and become, more pernicious. But you're saying like the next 10 years might actually turn out to be similar to the previous 10 years. We just get some increasing asset price inflation even more.
The truth is, wages in real terms in the United States have not gone up since 1974 in any meaningful way. So they've underperformed almost everything. So what that means is your wages, your income has remained static while the cost of assets has gone up. So you're actually poorer. What is that? Why? What is an asset? An asset is delayed consumption. You put your money into the asset, and in 20 years' time, you sell the asset and you spend the money. Right? That's the point of owning assets. They're delayed consumption. What it means is your future self has now got a lot poorer because this stuff keeps going up faster than your wages. This is the real dramatic problem. That equation of can you get wages up to create demand push inflation? No. Can certain cohorts' wages go up? Sure. But overall, you can't, because everybody in Silicon Valley's job is to drive costs lower. And it's a really dramatic situation. This creates a huge amount of anxiety, social anxiety. People don't know why they're getting screwed, but they're getting screwed. And it's not just the Fed raising asset prices. It's actually the fault is of the silent generation who had too many kids after World War II. That's if you want to blame somebody, and World War II was a feature of World War I because they didn't pay they refused to allow the Germans to forgive their debts. So it's a long story of how we got here, but it's not going to change.
We're all paying for the sins of our fathers, I guess, probably while committing new sins without knowing it, that future generations
Well, that's right.
will reap.
You don't know the law of unintended consequences. I mean, nobody thought that this is what would happen. Is after the euphoria of World War II, 70 years later, you'd create a massive collapse in growth, which has happened in Europe, Japan, everywhere else that had post-World War II economies. They all did the same. The others are slightly older because they had a lower rate of immigration than the United States did. And what happened was they all started, their economies started slowing down faster than the US. But it's baked in the cake. It's difficult to avoid, almost impossible.
So that's the macro story. Now let's maybe burrow another layer deeper here, but still related. I know you've had a thesis, Raoul, that's basically like macro and crypto. Those two things will converge. That's going to become one and the same thing. It's just it's a fast convergence, but people might not see it coming. What have we seen over the last 9 months in the macro story of crypto? Has there been more of that convergence? Are they now close to one and the same, or what's changed?
So I think they're the same. So if I go to my peer group and the people I really respect from macro hedge fund space, right? So that's the pointy end of macro. Those are the guys. Almost all of them have transitioned across in one way, shape, or form, either entirely or partially.
Really?
So like